Good evening, everyone. Hope you're doing well. I wanted to talk to you today about the RBA's announcement that they've left interest rates on hold. Let me just hide that and make sure we're recording. That's ticking over. Okay, so we're on the Reserve Bank of Australia's website. Now, I understand some of this may seem a little boring on the surface, but I've loaded up a bunch of graphs and information to back up some of the things in the RBA statement. And I'd like to go over some of this with you so we can get a better picture of what's going on. Hopefully you like my big purple mouse pointer, which I should have done in previous videos. So today the RBA's left rates at 4.35% unchanged. And this is from their carefully prepared statement. So every word would be fussed over, every detail that they wanted, how they want to present it, how they want to word it. So the RBA admits inflation remains high and is falling more gradually than expected. Well, I would argue that in some cases it's not falling at all, but fair enough. At least they're admitting it's a problem. So the RBA has said it's declining more slowly than expected. The CPI grew by 3.6%, down from 4.1%. So notice they quote the number here, 3.6%, which is the headline CPI. They don't care. Then they go on to say underlying inflation was higher than the headline inflation and declined by less. So why do they tell you that inflation's 3.6% there and then say that the underlying inflation was higher? Where's the number? Of course, they don't want to tell you the number, but that's okay. We can go over to the Australian Bureau of Statistics, the government website, and we can have a look at some of these numbers. So firstly, if we look at the trimmed mean, which is a fancy way of trimming out some of the things they don't want to count, whoops, it's actually higher at 4%, so well above the RBA's target. And then if we scroll down to what they call tradable and non-tradable. So let's go back to the RBA statement. So they said this was due in large part to services inflation, which remains high. Um, Now, what I wanted to show you is so they break down the inflation. So non-tradable, so measuring inflation with items, goods and services that are mostly influenced by domestic factors, and tradables is prices that are, generally for things we import. So they're talking here about deflation where prices are lower. They're seeing deflation, so they're seeing price decreases imported goods, including footwear, clothing, accessories, furniture, household appliances. So things we don't make here in Australia, those things are actually falling in price. Now, those aren't things that the RBA really has much influence over. I mean, if an air conditioner is made in China, or if some footwear is made in Bangladesh, or clothing accessories made, somewhere overseas, the RBA, the Australian government, they don't control the price of that. The only influence the RBA could have on that would be to jack interest rates up, strengthen the Aussie dollar, and make our exchange rate a lot more favorable to make those items cheaper. And of course, they haven't done that. So this is just pure luck. This is deflation occurring outside of the Australian economy, no thanks to the RBA. Now, that inflation rate, which factors into the RBA's overall CPI, is 0.9%. So these items that are being imported from overseas that are subject to overseas factors that are beyond the RBA and government's control generally, that inflation rate's only 0.9%. But note the RBA said underlying inflation was higher. Right. Well, I would say one of the ways to measure underlying inflation would be to measure goods and services that are influenced by domestic factors. Now, the inflation rate on those is 5%. Look at that. 5%, according to the Australian Bureau of Statistics. And I would argue that that number even understates it. And of course, if we come across to this graph here, if we take the non-tradables, so domestic inflation within Australia, and we take a 6-month annualized rate, you can see it's running at 5.77%, double the RBA's inflation target. Why aren't they raising rates? And they can't raise rates because we have a real estate hyper bubble and the economy is already in a per capita recession, so they can't do much there. Now, here's another interesting chart that I wanted to show you. And again, further evidence that we've just funneled all our money into real estate. We have a massive bubble. It's destroying our economy. It's destroying young people's future. Working class people who are renting can't afford to buy a house. They can't save for a deposit because they can barely earn any interest when they save money in the bank. And then, of course, because of inflation, their cost of living is a lot higher. So they can't even save money in the first place. But what this chart measures is business credit, so business lending, as a proportion of overall business and mortgage lending. So you can see back in the late 80s, well, let's say late 80s, banks would 70% of the loans would go to businesses. So businesses want to borrow money, they want to expand, or they want to start a business, they want to expand, they want to hire new workers, they want to buy new equipment, et cetera, et cetera. Lots of money being loaned to businesses because the RBA is going on about how, there's no productivity growth. They're worried about, and haven't memorized the statement. If I just go Control F and we go productivity, here we go. So that they were talking about it's begun to moderate slightly. They're worried about, and you'll see some commentators talking about, there's no productivity. Well, in order to have more productive businesses, don't they need to be able to borrow money to expand their operations, right? Have a look. Now it's down to, well, he said 34%. Well, that is actually correct, 34%. And why is that? Because all the money, all the capital is flowing into housing. Everyone's borrowing money to speculate on real estate, and we'll have a look at that. What better time to look at that than right now? If you want to see some evidence of, my apologies, I haven't, would have been easy. Here we go. So here's a place in Sydney, an apartment that sold for $1.1 million. Let's have a look at this beautiful apartment that you can buy in Australia for $1.1 million. And this is where all the money's going. Look at that beautiful floors. What a view. Look at that kitchen, retro kitchen, 1960 style, beautiful kitchen that you get in your $1.1 million shitbox with that bathroom. Toilet doesn't flush. You don't need to flush it. You're a real estate owner in Australia. That's it's such a wonderful thing to be, especially if you're an investor. Think about the negative cash flow return you could get on this beautiful piece of property. And of course, let's have a look at what it sells for. You can't hear the sound. My apology. Here we go. 1.1 million. Yay! What a great buy that is. All right. So all the money flooding into real estate, causing a big bubble to the point where people will pay $1.1 million for that piece of crap place that you can't even live in. So anyway, but so that is a huge part of the problem. Huge part of the problem. Uh, so the RBA acknowledges that. So here's the central forecast. So they are. So keep in mind, we've already had all this inflation. The cost of living is out of control, and their assumption is for inflation to return to the target range of 2 to 3%. Now it's going to take until the second half of 2025. So it's going to take at least another 12 months, possibly up to 18 months, or to the midpoint of 2026. So you're talking a year and a half, 2 years before the RBA now expects inflation to be running at 3%. So keep in mind, that means all the inflation you've already had, they're going to allow it to run above the 3% upper band target range for at least another year, possibly another 2 years. So as much as prices have gone up, maybe they're going to go up another 3.5% or another 4% on top of what they've already gone up. And let's have a look at the Australian Consumer Price Index. This was in the June 2020. So this is about 4 years ago. Something that cost you $114 now costs you $133.70. And of course, they're not even truthful about the inflation numbers. This is a chart of rents. And you notice that in the government data, the CPI, they're saying rents are rising at about 7 and a bit percent. But the private sector taking rents that are advertised is showing rental price, the price of rent, the cost of rent going up 10%. So keeping in mind 31%, so one third of the country rents, and out of those people who rent, they spend about, on average, about 30 to 32% of their income on rent. It's a massive expense for them. So that should factor into the CPI very heavily, because for a lot of people, especially living in Sydney and Melbourne, like the person who's going to be renting this beautiful apartment here, they're going to be spending 50% of their income renting this shithole. Why isn't it why isn't it being reported more on the data? And I read an article the other day. Apparently, a lot of people are getting rent assistance. So what the government's doing is they're saying, okay, well, the rent went up by 10%, so that's the actual price. But a lot of people renting property are getting rent assistance. So the rent might have gone. Let's look at a chart of rents in capital cities. I know I've loaded one up here. Well, Sydney, here we go. Sydney rents going up from 550 to 750. But the government's saying, okay, well, the person is not paying 750, they're only paying 650 because they're getting some kind of government assistance. So they're not counting that in the CPI, and that's how you end up with the actual rent being higher than what the government's reporting in the CPI. But if the government is giving someone money to help them with their rent, then we as society are paying that cost. So while that individual might not be directly paying the cost, it needs to be factored in the inflation numbers. So I would argue that these inflation numbers, they're not real. Uh, they're they're underreported in my view. But getting back on track, as much as your prices have gone up over the last few years, the RBA is saying we're going to let them keep going up at another 4% a year. And then by maybe 2025, 2026, we're just going to let them go up another 3%. So they're going to keep going up, but they're not going to go up as much. And the question that I would be asking the Reserve Bank governor, and I don't understand why any of these journalists don't know how to ask, she does press conferences, she answers questions. I would want to ask her, and let's look at a maximum chart. Here's the CPI going back to the 1970s. In 1970, something that cost you $10 now costs you $137, $134, sorry. And again, I don't agree with these numbers. I think it's much worse. The question I'd like to ask the RBA governor is why are you targeting 3% inflation or 2 to 3% inflation? We don't need prices to go up anymore. Australian working class folk need prices to come down or at least be flat, at least stop them from going up. You know, it should be a great source of frustration and anger for many working class Australians. So in the near term, inflation is forecast to be higher. Okay, well, why didn't you raise interest rates? Why have you got interest rates at 4.35%, a ridiculously low rate of interest? And they're saying, now keep in mind, the last 6 months I've been talking about the price of oil and how that was going to have an impact on inflation. And I called out the RBA and said, why aren't they talking about it? Well, here they are. It forecasts inflation to be higher because of the recent rise in domestic petrol prices. Of course, the price of petrol is very important. The price of oil, the price of petrol, very important to inflation, right? It's not just the petrol you put in your car. Think about all the stuff you need to buy at the supermarket being transported around the country in petrol powered vehicles, all right? So, and higher than expected service prices. So, again, we looked at that earlier. That's inflation domestically. They're talking about how there's a section here where they're talking about households struggling a bit. So at the same time, household consumption has been particularly weak. High inflation earlier have affected real disposable incomes. Well, let's have a look at that. Let's look at some charts here. Here we go. Why can't we see that properly? Let's zoom in. All right, here are the other OECD nations. So other nations around well, actually, I don't even know which nations are part of the OECD. I should have Googled that before starting the video. But other nations, this is real gross household disposable income. So real means adjusted for inflation. So if there's 10% inflation and your income goes, if you've got $100 and then you get a pay rise, now you're earning $105, but inflation's 10%, well, you're $5 worse off. You're not as wealthy. So you can see Australia, over the last couple of years, since all the lockdowns, because the virus was going to get us, massive decline in our actual income, like our real incomes and our debt service ratio. So this is 2008. So this is percentage of household money spent on servicing debt. You can see in 2008 where it peaked just above, maybe that's 18%, 18.5%. And of course, we know what happened in 2008, big problems. Look at where it is now. Look at where it is relative to other countries. Why is our debt so high? Because we have a massive real estate bubble and we have variable rate loans. So even though the RBA hasn't adjusted rates very high, we're still seeing massive debt burdens on Australians. And here we go. Here's a better chart. Household disposable income. So again, our household income adjusted for inflation. Have a look at how the rest of the world's doing, even the US, the G7 countries, the biggest countries on the planet. And of course, how's Australia doing? Well, look at that. We are in big trouble when this is probably why a lot of households are feeling like they're in a recession, because they are. And here's another, well, I don't know why that's zoomed in so much. My apologies. And just another graph of the percentage change in household disposable income. And as of the latest data, I guess that's late 2023, our real household income is falling by 5%. So when you adjust for inflation, the average household in Australia by this particular measure is 5% poorer. I would say that's a terrible thing. Now, coming back to my point earlier about, why would the RBA want to let all this inflation run and then by 2026, they're going to bring inflation down to 3%. I wish I had a chart of this for Australia, but it's easier to get data on the US. So what's happened is, because inflation has pumped higher over the last couple of years, you can see this blue line assumes that inflation would be running at the Federal Reserve, the US Federal Reserve's 2% inflation target. And this is what would happen to prices on this index. In 2015, about $235 would then require you to spend $280 in January 2024. But because inflation went way out of hand in 2022, this is where it's at now. All right. So the point I was trying to make is, why are central banks well, we know why. It's because the governments have too much debt. Everyone's got too much debt. They can't raise interest rates high enough to fight inflation. But with inflation up here, wouldn't we want it to go back down? Well, for starters, why would we want it to go up? But to the extent that it's going to go up 2% a year, don't we want to bring it back down to the 2% average? That would require a few years of deflation, of negative inflation, of falling consumer prices. All right. And that would require the RBA to jack up interest rates, not to 4.35%, but maybe to 6, 7, 8%, and maybe see mortgage rates in Australia go to 10, 11, 12%. Now, there's probably not too much else here that we need. Household consumption has been particularly weak. Of course, it has. We just looked at some data on that, and returning inflation to target is the priority. Well, why is it a priority to make inflation be at least 2% a year? Right? And if it's a priority, why aren't you raising interest rates? And we know why. It's because Australia is already in a per capita recession. We're not having, per person, there's no growth. We have a massive real estate hyper bubble. We have people drowning in debt. We have rents, Australian capital city rents. Look at those rents just since 2020. Look, again, this is consequence number 47 of the COVID lockdowns, and we're only at the very beginning of those consequences, in my view. Look at the skyrocketing rents. This hurts working class people. It makes me upset. Now, let's have a look at how the stock market reacted. And of course, the Australian market, massive pump today. Look at that big green candle. It was up 110 points, or 1.44%. Keeping in mind that's an all-time record high for the Australian market. So thank you, RBA, for people who have money invested. Investments are pumping in price. And if we go to a 5-year chart of the Australian market, and I'll make this the last thing I talk about today, you can see that was the pre-COVID crash high. And we had the recovery after the zero or near zero interest rates and the $450 billion of money printing from the RBA. They pumped the markets back up. And it's actually going to be hard to draw this line because you can see the peak there in August 2021 that held all the way through until this year. And you can see there was a high there, a touch there, a touch there. And again, this is straight out of the textbook. If I was going to give someone a charting example, the Australian market, this is a weekly chart, 5-year, well, a little bit shorter than 5 years, August 2021 to today. And what you can see here is what you call an inverse head and shoulders pattern, with the left shoulder, the head, the right shoulder, very bullish pattern. And generally what happens when markets break out is, let me get my highlighter. So you got a touch there, see resistance, that's a ceiling. You can see in January this year, it made its first break, has a little retrace, and then gets above, makes a new all-time record high, returns to the scene of the crime. See that? Returning to the scene of the crime to test the breakout, and now we're pumping again. So we don't know for certain what will happen in the markets, but this is a very bullish chart pattern, and it's very likely that the Australian market is going to trend higher. Now, my opinion is that we should be lightly invested in stocks because it is near an all-time record high. Stocks are very expensive around the world. It's just that the Australian market has not done as well. If we zoom back, so that's what we were looking at there, and this goes back to 2008. So you can see the underperformance of the Australian market over a 15-year period. You can see as late as Christmas 6 months ago, the Australian market was at the same price it was at in October 2007. So very little growth. So that's why I'm not recommending anyone short the Australian market. It has been a massive underperformer for many, many years. And I'm just going to show you very quickly. Let's compare it to the US market, the S&P 500 on a percentage scale. Have a look at the performance of the US market since the 2007 high. In fact, let's take the low. That's the low in 2009. The Aussie market is up about 128% over a 15-year period. What is that, 15 years? Yeah, it is 15 years. Wow, time's flight. US market up 544%. it's outperformed by about 5 times. But you can see stocks are very expensive. I've run out of time. Hopefully that's some good info. Please reach out, ask questions if you'd like to discuss these further. Thank you for listening. Have a great rest of the week. Talk soon.